Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Maximus, Inc. quarterly report. Maximus, Inc. provides a wide range of government services globally through its three segments: U.S. Federal Services, U.S. Services, and outside the U.S. the company's U.S. Federal Services segment offers various business process services, including eligibility and enrollment, outreach, clinical services, technology solutions such as application development, enterprise business solutions, advanced analytics, cybersecurity services, data management, and infrastructure engineering solutions. In addition to these services, Maximus U.S. Services segment provides program eligibility support and enrollment, multilingual customer contact centers, digital self-service options for enrollment, application assistance, beneficiary outreach, education, eligibility, enrollment, redeterminations, subsidized telephone services, person-centered independent assessment services, employment services, technology solutions, and system implementation project management services. Maximus outside the U.S. segment offers business process services, BPS, and technology solutions to international governments, including health and disability assessments, program administration for employment services, well-being solutions, digitally enabled customer services, and technologies for modernization. Unfortunately, I do not have access to the text you provided. However, I can still provide a general essay on what could cause a stock price to increase. The stock price of Maximus, Inc. has increased slightly over the past year due to several factors. One possible reason is the company's strong financial performance. Maximus, Inc. is a leading provider of government services and solutions, and its revenue growth has been steady in recent years. This stability and growth have likely contributed to investor confidence, causing the stock price to rise. Another factor that could be contributing to the increase in stock price is the company's strategic acquisitions and partnerships. Maximus, Inc. has made several key acquisitions in the past year, expanding its services and capabilities in areas such as healthcare and education. These moves have likely enhanced the company's competitiveness and growth prospects, making it an attractive investment opportunity. Additionally, the increasing demand for government services and solutions is also a contributing factor to the rise in stock price. As governments around the world face growing challenges related to population aging, healthcare costs, and economic development, they are turning to companies like Maximus, Inc. to provide expertise and support. This trend is likely to continue, driving growth and increasing demand for the company's services. Overall, the combination of strong financial performance, strategic acquisitions, and increasing demand for government services has contributed to the slight increase in Maximus, Inc. stock price over the past year. The Maximus, Inc. market capitalization of $4 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Maximus, Inc. holds a significant advantage in their industry. Maximus, Inc. trades at a lower price-to-earnings ratio of 11 times and a higher price-to-book ratio of 2.36 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 59% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified by examining the key factors that have contributed to these changes. On the growth side, government services and healthcare segments have been major contributors, with U.S. services revenue increasing by 8.5% from 2024 to 2025. Clinical services also saw a significant increase of 11.4%. Additionally, unbilled receivables due to contractual retainage provisions and recognition of deferred revenue balances have added to the growth. On the decline side, federal government contracts have decreased, leading to a total revenue decrease of 3.8% from 2024 to 2025. Program operations, employment and technology solutions segments have also seen significant declines in revenue. Furthermore, gross profit percentage has decreased by 6.1%, indicating a potential issue with pricing or cost management. In summary, the primary drivers of revenue growth are government services, healthcare, and clinical assessments business, while federal government contracts in certain segments such as program operations and technology solutions have driven revenue decline. The net income and profit margins of the company have undergone significant changes over time. Notably, the net income has increased by a substantial 128%, rising from $41,196 to $93,943. This increase is accompanied by improvements in gross profit margin and operating income margin, which have risen to 23.6% and 10.9%, respectively. The factors contributing to these changes are multifaceted. One key factor has been the decrease in cost of revenue, which has likely resulted from increased efficiency and reduced waste. Additionally, the stability of volumes across multiple programs has provided a stable foundation for growth. Furthermore, the adoption of technology initiatives that enhance staff productivity has also played a significant role. However, it's worth noting that the increased resources needed during the open enrollment period may have presented some challenges in terms of managing costs and maintaining profit margins. Nevertheless, the overall impact of these factors has been positive, leading to improved net income and profit margins for the company. The company's financial performance indicates a significant milestone. According to the provided summary, one of the key takeaways is that the company is successfully generating positive operating cash flow. This achievement is a testament to the company's ability to manage its finances effectively. On page 20 and page 37, further details are available regarding this accomplishment. However, the most important aspect is that the company has achieved a crucial financial goal, which sets it apart from others in its industry. The generation of positive operating cash flow demonstrates the company's stability and potential for long-term growth. The company's debt level and interest expenses have undergone significant changes in recent years. The total debt principal has increased from $1,346,875 to $1,579,375, while long-term debt has risen from $1,281,593 to $1,509,205. This increase is largely due to proceeds from borrowings, with amounts ranging from $365,000 in 2024 to $435,000 in 2025. As a result of the increased debt level, interest expenses have also risen. The company's interest expense has grown from $17,522 to $20,816 and is expected to continue increasing due to the expansion of Term Loan A credit facility. Furthermore, for the trailing 12 months ended December 31, 2025, interest expense reached a total of $87,374. The data suggests that both debt level and interest expenses have increased significantly over time, indicating a growing financial burden on the company. Management is confident about the company's strategy and progress, citing that it is on track with its initiatives. The company aims to maximize the value of its backlog while continuing to manage growth, including acquired businesses. One key area of focus is improving profit margins, which are expected to reach 10.5–11% in FY26 due to increased resources during the open enrollment period. Management also expressed optimism about the company's financial position, stating that it has sufficient cash and access to debt facilities to meet operating requirements, long-term debt repayments, dividends, and share purchases. The sale of its child support business is expected to provide additional cash, further bolstering the company's outlook. Overall, management's comments convey a positive tone regarding the company's prospects for growth and financial stability. In recent years, our company has undergone significant changes through strategic acquisitions and divestitures. One notable acquisition was made in fiscal year 2021, where we invested $393.7 million in technology-based assets. This move aimed to enhance our capabilities and stay competitive in the market. On the other hand, we have also made deliberate decisions to divest certain businesses that no longer align with our strategic objectives. In December 2024, we sold several businesses outside of the United States, resulting in a charge of $38.3 million. This move was likely taken to focus on core operations and reduce operational costs. Additionally, in December 2025, we successfully exited our child support business within the United States, generating a gain of $9 million. These divestitures demonstrate our commitment to adapting to changing market conditions and optimizing our portfolio for long-term success. The company has demonstrated its commitment to returning value to shareholders through both dividend payments and share buybacks. In terms of dividends, the company has consistently paid out a quarterly amount, with the most recent payment being $0.33 per share, totaling $18 million. This is an increase from previous payments, which were $0.30 per share. The company's dividend policy suggests a commitment to rewarding shareholders through regular payouts. In addition to dividends, the company has also engaged in significant share buybacks. In the most recent quarter, it purchased approximately 0.4 million common shares at a cost of $31.1 million. This is part of a larger trend, with the company using $228.6 million to purchase common shares in the first quarter of fiscal year 2025. The total amount spent on share buybacks was $31.055 million as of December 31, 2025. Overall, these actions demonstrate the company's focus on returning value to shareholders and its commitment to a robust dividend policy and strategic share buyback program. That concludes the financial summary for Maximus, Inc. Feel free to comment below, and I will be happy to answer them when possible.